Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's senior strategist, Kevin Cook, to talk about when you should sell a stock. This is the biggest question I'm getting on Twitter. Zach's portfolios had two stocks up over 600% in 2020. Just in that 1 year, they were up over 600%. And some others in the Zach's portfolios have soared 200 or 300% in the last 9 or 10 months. And I'm sure many of you have stocks that have done the same. Then there's also the issue of people who have been long-term investors who also have big winners. Some of those can be, up 10 baggers, as the saying goes, and up, triple digits and more as well over the last 5 to 10 years. So when should you sell? This is one of the most difficult questions in investing, I feel. And there's a lot of components to it. So I asked Kevin to be on the show this week because he recently sold a big winner out of his healthcare innovator portfolio. And I was kind of surprised to see it because it's a big winner and suddenly, he's selling it. So that stock was VCEL, ticker VCEL. And so, Kevin, I asked you to come on because I saw that you sold that. And I was wondering, why did he sell it? How did he know to sell here? And maybe you could give us some of your wisdom and insights to help everyone out there who's sitting on these big winners and wondering whether or not they should cash it in.
Yeah, well, I'm glad to be here, Tracy. And we both know you didn't call me just because of that one stock sale, because this is a theme that actually you and we talk about a lot. We've done several shows where we talk to people about how to handle corrections and bear markets and panics and crashes. Yeah. And so this is kind of the flip side of that, like what to do when you've got big winners.
Yeah.
And, whenever anybody asks me, hey, should I sell this? My first answer is it depends, Right. So I kind of go through with them like, well, what was your original rationale for buying the stock? And did you have what was your objective? Was it just a short-term trade, or was it, you thought the stock had 50 to 100% upside over a year's time? Or did you think it was a world-changing stock, a biotechnology stock, a great software stock, a Tesla? And, so then you got to kind of gauge it like, why did you come here? And then just like when somebody asks me, should I buy a stock? My first question to them is, well, what kind of money is this? Is this 2-year money? Right. Then maybe you shouldn't buy this stock now. But if it's 20-year money and you like the investment, then yeah, start buying some now. So it's kind of the same thing when you sell. It's like, what was your objective and when are you going to need this money? And if your objective was looking at this as a disruptive innovator over the next 5 to 10 years, then maybe you just sit with 300% gains and let it keep running.
Yeah. Yeah, that's always the one thing I always tell people. What is your goal? What was your goal for investing? Have you reached that goal? And then the other component is what's happening at that investment? What's going on in that company? Is the story the same as when you bought it? Like, has management remained the same? Are they still doing what you hoped they would do? All of that stuff.
Right.
Look at both sides of the equation. I mean, we've seen companies that have blown up, obviously, over the years. And, you could just be kind of in it and with the old management and the old philosophy, and then suddenly you find yourself in this whole new world. So that's a whole nother component too that investors have to think about when they're thinking about whether or not to cash in and sell.
Yeah. And another way of looking at this, and you kind of touched on it, is, active investors already have a pretty sophisticated decision matrix about why to buy a stock, right? You touched on some things, What you like the industry, you like the innovation, you like the management, growth, valuation, catalyst, the chart, the price target. And so we have all these things in our decision matrix about why to buy. We should have sort of a similar decision process about, well, why sell? Do you just sell? You have to look at why were you in it in the first place. And one of the things that I like to get people to think about the math of investing. And I used to teach short-term traders, and short-term trading is like one of the hardest things. Like it's very hard to succeed. We hear stats like 80% of small businesses fail. Well, 98% of small traders trying to day trade fail because there's so much randomness and our emotions get in the way. We can't handle the high speed, green arrows and red arrows. And so we make bad decisions. We shoot ourselves in the foot. So what I used to do to help cure people of overreacting emotionally to the red and green arrows is get them to think in terms of EV. And by EV, I don't mean electric vehicles. I mean expected value. And expected value is like a simple formula for any kind of game where you take your win rate and multiply it times your average win ratio, like your win to loss ratio. And what that does is if you add up your trades, 100 trades or something, you end up with an expected value of about what you should make on any given trade. But the whole idea when you go into the mechanics of it is, I just have people do the math. Like they don't have to have a bunch of trades to do this math. All I'm trying to do is show them the equation that if your losses are too big and your winners are too small, even if you're profitable overall, you won't make it in the long run as a trader. This is also true of investing. When you think about it, you need to let your winners run just to make up for the losses, because there will be losses in investing, right?
Definitely.
So you need the winners to be big, and you need to let them run. I heard Peter Thiel one time say a lot of portfolios he's looked at, the biggest chunk of the gains came from one or two holdings. Now that's him speaking as a venture capitalist, where he might have 10 or 50 lines in the water, and a lot of them aren't going to make it, and then a couple of them blow up and become Amazon or Shopify or something.
Yeah.
So that's kind of extreme to say that one or two. I think that's sort of the way Bill Ackman plays is, he's going to buy 12 things and he's going to research them so well, and, a couple of them are going to really kill it. But for investors who are more broadly diversified, you still have to let those winners run. And here's what we're trying to fight is the temptation to grab the green arrow and cash it in, right? So
right.
people get so anxious about all that money on the table, and they want to put it in the bank. Right. And then if they do that too soon, a couple of losses could wipe out that gain. You could have a couple of 30% losses that destroy a stock that you had a double on.
Right.
So you gotta know. I mean, long-term investing. I mean, we can use Warren Buffett as an example all day, and we often do, because what's his holding period? Forever, right?
Right.
Later on in this, as we get going here, I want to bring up a couple other really pro investors besides Warren Buffett who are good at the long-term holding period.
Right. But even with the long term, if you look at what Buffett has been doing the last couple of quarters, now it may be him or it may be his lieutenants. We don't know, because he never really tells us who decides these things usually. But even with his Apple position, which is now completely dominating his portfolio because of the big gains there, he did sell some shares last quarter. He did take a little bit off the top there. So apparently he is cashing in on some of these big gains as well.
Yeah, and it might be it could be sort of a rebalancing thing for him. And exactly. You know what? He's not afraid to admit his mistakes, right?
No.
He wasn't in tech forever. He finally buys IBM. That turns out to be a dud. But along the way, somebody woke him up to Apple.
Well,
and
at 10 times, yeah.
You know what? And they probably showed him the cash flow, right?
That's right.
They probably, it wasn't about the phone and the trendy products. It was about, look at this cash flow. And he's like, holy smokes, give me some of that.
Yes, he loves that. Yeah.
So when I talk about people eager, we get so anxious about that green arrow and we want to hang on to that money and put it in the bank before it goes away. Part of the problem is that, well, this is the way I sum it up. As an investor, if you're seeking perfection, you should see a psychiatrist because there is no perfection, right? We're all going to make mistakes. We're all going to pick stocks at the wrong time and lose money. So this tendency we have where our brains are like, it's the monkey mind. The monkey mind is like, so tense and nervous, and we experience this agony of missing the top or the bottom. Well, nobody gets the top or the bottom all the time. Right. And if you live in that world, what happens is it clouds your decision making, it drives your money away, and it prevents you from ever developing a set of rules and a process, so that you can be systematic about, well, this was my rationale for buying this stock. I still think it has 5 years to run. So I'm going to sit with the 200 or 300% win. I mean, the big investors besides Buffett that I wanted to bring up are a couple that killed it in Tesla, along with some other things. And that's the Scottish hedge fund, Baillie Gifford, which was founded in Edinburgh in 1908 and is still there. and then ARK Invest, Cathie Wood. Yeah. So I call that duo Bailey and Cathie. And these are the professors that you want to learn from because they were both huge Tesla investors. Baillie Gifford was the largest private Tesla holder besides Elon Musk. And Cathie Wood with ARK Invest was right up there too. Yeah. And they never faltered. I remember once I discovered their large positions in Tesla, and with Cathie Wood had like a $5,000 price target. You and I did a show on it in January, and then she moved it up to $7,000. This was a year ago. They didn't panic during the Corona crash, and I was saying, hey, listen, Tesla. Now I'm a believer in Tesla. Once I understand Cathie Wood's thesis about how they're going to dominate autonomous ride sharing with 80% gross margins, I thought, wow, Tesla's probably going to crash at some point from $1,000 back down to $500, and I think we should buy it. But did I do that during the Corona crash? No, because everybody was saying the economy shut down. The Fremont auto plant for Teslas, that's going to shut down. This is not the time to be buying car stocks.
Yeah,
And Baillie Gifford and Cathie Wood never, they just hung on. In fact, they were buying more.
But isn't what Cathie's whole thesis is about Tesla? Doesn't that plays into what you were just saying to start off the show, that you have a system or you have, this type of goal or this theory or whatever it is, and you stick with it. And she does have like a system of investing and she sticks with it. And that's why she still owns the stock. She hasn't sold it because she does have this whole thing set up around the stock. Now, she may be right or she may be wrong. We don't know yet, but she has it and she's sticking with it. And I think that's where a lot of people who also bought Tesla last year don't have that. That kind of system can be comforting to a lot of investors to give them an idea of what they should be doing, because Tesla hasn't reached the end goal yet that she has set for the company. So in her mind, like, no, of course I'm not selling. It hasn't reached that end goal. But the person who did buy it, let's say they bought it on the sell-off, they did overcome the issues that you were just talking about, why you didn't buy it, and they did buy it. And now they're sitting on about a 700% or slightly more gain. What do those people do now? Those are the people I feel I have the most anxiety from, because they don't have they didn't have a real objective like she has around the stock. And now they have this, what is an enormous gain. Let's be honest. It just is.
Yeah. And I mean, there's nothing wrong with selling some of the position too. It's like,
that was my next question. Like, I believe in taking some off the table if you feel that anxious about it, because what difference does it make if you're cashing it in? Like, that is part of your goal. We should hope that you wanna make profit and gains. So, but this goes back to the other component you were just also mentioning about the timing, and that some people believe like they're going to leave further gains on the table. They have 700%. What if it goes up 1,000 and they had sold half of their position? Then they're missing out. And so that anxiety about the missing of further gains is making them frozen, basically. Well,
and that goes back to the thing of seeking perfection. You're never gonna nail the exact top. And I should clarify that both the Bailey Gifford funds and the ARK Invest funds did have to sell some Tesla because the positions were too large a percentage of their portfolios.
Okay.
It was just a matter of, we can't have something that's 15% of a fund. We need to pare that down to 10% or lower, and they're that way they're prepared to buy the dips too. So basically they're doing an old school thing that I learned a long time ago from Jim Cramer is hold core and trade the balance, trade around it.
Yeah.
So you hold a core position and you buy the dips and sell the rips on partials, and that sort of funds it.
So let's go back to your VCEL, because I am curious about why did you sell that? Yeah. You had over 100% winner in it in a short period of time too, I believe, right? It was not real long that you've held that.
I bought it in July. And so VCEL, they have some proprietary technologies for skin regeneration from severe burns. So we're talking like 4th degree burns. They have a way to help your body grow new skin cells. And it's not, you're not going to be perfectly restored, but I've seen, when you're talking 4th degree burns, that's deep into the skin tissues. Those people will take, any kind of regeneration. And they also make products for regenerating your knee cartilage.
Right.
Other things. So when I discovered the company and learned a bit more about it last summer, trading under $15, and looked at some of the analyst reports, there was an analyst at Oppenheimer who was very optimistic. He had like a $33 price target. And then I saw them seeking FDA approval for one of their formulations called Nexobrid, which that's still pending. I thought, I like the risk reward here. And the stock finally started to get noticed, and, got over $30, and there were no analysts, with price targets really. I mean, the average price target was like 27. And so at $31, I thought, they're still going up against the FDA gauntlet to get approval for the next level of this. I'm just going to take the 100% gain now and see what happens, because it's still a small company. It's still, something could go wrong with the FDA. Whenever you're going into an FDA approval, it's a coin flip, it's a gamble.
Right.
So, so that was sort of my decision matrix, is like, I got a big chunk of what I came for. And, if tomorrow some big biopharma company comes and buys them for, a couple $1 billion and the stock soars to 50, will I kick myself? Maybe, but I do hold a lot of stocks in my healthcare portfolio because I think they are great assets that a big biopharma company might want to buy.
Yeah.
And in fact, we're coming up to the JP Morgan Healthcare Conference next week, which is always a big time for a company to announce M&A activity.
Okay.
And 3 years ago, in 2018, I hit a grand slam where I woke up on a Monday morning and I had 2 companies bought out in early January.
Wow.
One was Juno, which is in CAR T therapy, and another was BioVerativ, and they were both bought out for big premiums. But you know what? That's never happened since. I've never had 2 companies bought the same week, let alone on the same day, around the J.P. Morgan Healthcare Conference. So there's always that M&A aspect where you think, so I do hold some things that are just kind of drifting sideways because I think they're great undervalued assets, and they could either get bought or they could cross the next FDA hurdle. So that's always the trickier part with healthcare.
Okay, so it sounds like VCEL met your goal for when you bought it. It met the goal, and that's why you decided to take your profit and get out.
Yeah, I mean, it actually exceeded the goal because it exceeded all analyst price targets basically, even before it got through its next FDA window.
Okay, wow, that's one to keep on my watch list though, because I know you've talked about it before, and
and for the regenerative knee cartilage business. Yeah, they've got an Olympic swimmer who's she's probably in her 50s, and she had some knee problems. She's a mother, and she does a testimonial for them about how she got her knees back because of their technology.
Yeah, the knee cartilage part intrigues me. Maybe even more than the burn part, but both are really great. So yeah, there's a lot of people with knee issues that have to get the knee replacement that they otherwise might not need to do if they had a product like this. Mm-hmm. So that'll be interesting to watch. Okay, so let's switch over to a different scenario and I talked a little bit about this at the open as well, about the investor who is a long-term investor. They bought years ago, and let's say they bought one of the FANG stocks years ago. And I have a friend who bought Facebook, ticker FB, as everyone knows, a little bit after the IPO when it fell back, when it sold off. And he has a cost basis of $30 a share. And the shares had traded as high almost at 300, I think, last year. So he basically has a 10-bagger in it. What about investors like him, who he has held on through the ups and the downs, and he has the big winner in there? In any of the FANG stocks, I guess you could say the same thing. They all have done well over the last 5 to 10 years, basically. So what about those investors? Does the same kind of analysis apply? Do they still go back to why did I buy this? What is my goal? And how do you decide when to sell one of these long-term winners?
Yeah, now, I mean, I can talk about this a couple different ways, and I'd almost prefer to talk about it company specific.
Okay.
Kudos to your friend who did this.
Yeah.
Because he hung on.
That's right.
But I would have been scared out with all the regulatory
privacy
pressure that Facebook was up against. And I mean, got to be honest, Zuckerberg never looked good when he went to the Hill, right? He was always in the crosshairs, and he didn't come off as, remorseful about anything or conciliatory about anything, So it was just like, oh my gosh, they're going to hammer him, and you can't fight the government. So if industry regulation is going to change a business, but that hasn't happened. So then it's like, so in the one sense, we opened with saying, well, what was your original thesis for buying, and how much of that has changed? Was this a 1-year investment or a 10-year investment? But with a Facebook, you're allowed to reevaluate, right? Especially when the government's involved. I have a similar story with Alibaba. I've always been a big Alibaba fan, but they just ran into a big regulatory wall. First, Jack Ma must have really annoyed the party rulers, and so they wouldn't let Ant Financial go IPO, which was what put Alibaba above 300 a share. And then they're getting drawn and quartered for possibly antitrust action. So, so that's why Alibaba's got knocked down. Facebook has seemed to, sort of find its way. And then you have to look at it. Okay, if they can get on Washington's good side and clean up their act with whatever it is, privacy, disinformation, any of that, then where will the core business make money? And if it's just advertising, I would say, reevaluate. Also, look to diversify. The killer advertising platform of 2019 and 2020 is the Trade Desk, which is what I call the CME of advertising on the web and on connected TV, streaming TV. They're basically, stealing from the walled gardens of Facebook and Google by allowing advertisers to just program their ad buys systematically across all platforms 24/7. So, yeah, you could still hold Facebook, but look at where advertising dollars might also go if that's still Facebook's core business.
Yeah, that gets back to what I was saying, that, the longer term investors who have these big winners need to really evaluate and check in on what their companies are actually doing and whether or not that business remains the same business that they bought or is going in the direction that they want it to go into and all of that. That's definitely a good thing to point out, because a lot can change in 10 years or 20 years for sure. And people need to be checking in and not always expecting everything, is just going to be run smoothly along all that amount of time period.
Yeah, and I'll give you a real specific example again between Facebook and Alibaba. As soon as the regulatory stuff slammed Alibaba, I started selling some, because I'm like, you cannot fight. Not only cannot you not fight the U.S. government, you definitely don't want to fight the Chinese government, and that's actually been a thesis of yours for a long time. Is you do not like it's like the favored company status or not in China,
right?
And that's why I only stay with the big companies. I didn't think that Alibaba would run afoul, but obviously Jack Ma said some things that were not acceptable to the party, right. And so what I did is I sold some shares to make me feel more comfortable. And I didn't sell at the high, I didn't sell over 300. And now I'm in a position to, after this settles down, maybe I buy some back. And I think a lot of Facebook investors did that too, when Facebook first started having problems after the 2016 election. And since then, and, at least in your friend's case, he was just like, I'm just holding this forever.
Right. Yeah, that's the thing. I own Facebook in my own personal portfolio too, and I did not sell when they had all those initial privacy issues.
Okay.
And I haven't sold it now either, now that they have the FTC. Like, there is a legit concern that they may be busted up and may have to spin off like Instagram or WhatsApp or both of them separately. But
we hear all these smart people like Professor Galloway. He thinks they should all be broken up, right?
Yeah. And the same thing with Google. I mean, Alphabet, they could spin off YouTube and a couple of their other divisions too. But we'll see what happens. But it doesn't seem to be impacting the actual stocks right now, at least. But it is something.
Does that mean we're in a bubble?
I don't know. Maybe. I mean, this is some of the things that get glossed over when things get a little too hot, right?
Right.
Okay. So another type of stock that I did want to talk about were some of the pandemic plays, the work from home or stay home type of plays that had huge gains in 2020. So one of those would be CHWY.com, CHWY. It soared because everybody got pets and they were all ordering all their pet supplies online. But it's started to turn over, it looks like, and the shares are down pretty sharply off of their December highs here. it doesn't have a PE. It's gonna expected to see a loss of 34 cents this year and still another loss of 8 cents next year. It has a price to sales ratio of 5.6. So is this like these types of stocks, the pandemic plays that were more, based on events rather than other things going on? What should investors do who got, into some of these at the right time? Does this follow the same advice we've been giving that they need to, think about their goals, why they got in, all of that? Or should they just be, take the gains and get out of these ones?
Yeah. So CHWY is that pet supplies?
Yeah.
Yeah. So I don't know that much about it, but it's so funny that we're even talking about this because what was one of the poster child of the 2000 melt up and crash? Wasn't it was it pets.com or something?
It was pets.com and Webvan, which was
right.
Supermarket delivery.
Right. So
they were both ahead of their time.
Yeah. So the pet food thing is maybe CHWY, obviously benefited from the shutdown and really now maybe they can establish this long-term business, but do they really have a moat, and do people want to go back to the store? My example is I look at Zoom. I could never understand how Zoom could soar like that when there's so many other alternatives, right? Like there's Skype, right?
Yeah.
Skype, which is mostly free. Google has a lot of things. Like I have a daughter in high school and they exclusively use Google. And so there's Google Meet, and then they can have, teachers can have meetings. And I don't know if they have to pay for, the volume of people they have on calls and stuff. But I just thought, how does Zoom have this moat that it's soaring, goes up to $550 or whatever? So I think when you look at it, did you really like a CHWY? Is CHWY, is it disruptive innovation? Is it going to be something that is changing an industry, 5 years from now? Probably not.
Right.
So maybe that was just a pandemic play, and maybe the business is established now and it has some kind of future. So you hold on to some shares. Right.
This goes back to our other advice that you can sell. No one's stopping you from selling a portion of your holdings and taking the gain and then seeing what else happens. And, I feel like that's like a good way to ease your anxiety if you're really feeling anxious that you're going to lose out on a lot of these gains. Then just cash some in.
Now you run the value investor portfolio here, and I wonder if you do the same thing I do with healthcare. Since I do have a long-term focus, I keep track of things that I sell for decent gains that were a long-term hold, meaning I held it for over a year, so it's long-term capital gains. Do you keep track of how many you do there?
Most of mine are long-term.
Yeah. See, that's great.
Yeah, because that's our mandate, is to hold, as Warren Buffett does, for forever if possible. But our oldest holding only goes back to 2018.
Okay.
Because it's, we have cashed in on some, and then some of the business models have changed over that time period. Like, say, for energy, we used to hold a bunch of energy shares, and then we had to get out of all of that. And we're still out.
Right.
One of those. Same thing to some extent with the banks, the big banks. We held some of those for several years, but then we had to get out of that once the earnings, started to get just slashed really horribly at some of the banks. So, but yeah, we hold for the long period over there, but it does, because that's our mandate. That brings up another issue too with when do you sell? Like, we have some that we've held for several years that are big winners in there, but we do what you and I just did on this podcast, and we look at the underlying business. Why did we buy it? What does that earnings picture look like? what's happening with sales. Is the management still good? Are they still following their strategy? All of that. And then we decide whether or not to get out. So, yeah, it's a lot of questions you have to ask.
Yeah. And, sometimes, the market is not rational and it is not efficient. I mean, if it were, everybody would either be rich or nobody would be making any money because everyone would be in the same trades, right? So look, I'm going to do a thing tomorrow, actually, for our team. I'm going to do a presentation on great stocks that were held down for a long time, and it seemed like half of Wall Street hated them, and then they exploded higher. Okay. And that list includes things like Square and Tesla, and my CRISPR stocks. BIDU just exploded, and guess who I found out was buying BIDU? Cathie Wood.
Really?
Yeah. Yeah, and I'm glad I got it. That was like the one time I got in something before her. But a little bit to my credit, I was already buying the CRISPR stocks for the past 3 years before I knew she was a heavy investor.
Yeah.
And Square, but Square is a great example of something that a stock that was just irrationally hated by Wall Street and held down at like $50 and $60 for the longest time. When I was following one analyst, Dan Dolev, who was like, the Cash App is growing tremendously. And when you look at the ecosystem, like I called Square the Apple of fintech, not because of products, but because once you got the one product that you could swipe a credit card with for your business, then it created all these other services for a small business person. Like, why would they ever want to leave? Accounting, loans, bookkeeping, sales tracking, inventory tracking, all this stuff and then Square would just use the data. And I couldn't believe how Wall Street hated the stock. And like, even coming out of the pandemic, there were banks saying, we're a hold, we're a sell, $70 price target is the best we can do. And, now Square's making new highs above 220.
Wow.
So that's one example of how things get. But what Cathie Wood did is she just bet on the innovation. She's like, they are going to be, this disruptive player in fintech. And I also call Square Jamie Dimon's favorite mistake, because in 2019 at a JP Morgan Investor Day, he was asked, Jamie, you guys are doing so many things right. I mean, who could possibly take you on? And he goes, actually, I'd like to turn it around and say, point at somebody who I wish we did what they did, and that was Square. So my point with that is, like, when you do pick something that you believe has this sort of disruptive quality, or as a technology platform that changes something 5 to 10 years from now, it can be hard to hang on, especially if it seems like half the investment community doesn't like it. And so, anybody who hung on to Tesla or Square obviously recognized that challenge. And the CRISPR stocks, for me, the CRISPR stocks just all exploded in December after the ASH meeting, the American Society of Hematology, and they may be on now to double and triple from here, because they went from 2 to 3 billion market caps. Now they have 5 to 10 billion market caps, but we're talking about a science that could be the greatest discovery of this century. Gene editing. Should all 3 of those stocks really just trade for less than 15 billion?
Yeah, it sounds like I'm going to have you on a podcast to talk about all this.
Yeah. Well, you'll see. We'll see how well I present it tomorrow to our strategy team.
Okay, so I feel better after doing this podcast. I feel, even for myself, I don't even own Tesla, but I feel like I did learn something on this podcast, and I now have strategies or ways I can think about whether or not I want to sell some or all of my Tesla. And that makes me feel better, even though I don't even own it. So
hey, let me give you one more, like Square, ROKU. Everybody, half of Wall Street hated ROKU. A guy at Wedbush was like, you sell this, it's going to $60. And I was like, I want to buy it at $100. But the bears got in my head saying, this is just a piece of hardware, that can be duplicated by anybody. And then Comcast came out with some copy that was only like $5 a month. And I thought, oh, that's it for Roku. Well, Roku is now, a $350 stock because, they were doing something, with connected TV and advertising and data tracking that has made the difference for their business.
Yeah. Yeah. Okay, so we talked about a lot of different stocks on this week's episode. I'm going to go through a lot of the tickers. And as always, remember to have a plan of what you're doing with your investments, because that will make you feel better. And I know a lot of people like the system types of investing. That's why we have the Zacks rank. The rank does help you to some extent with that kind of system thing. So might want to check out the rank if you're interested in that. It is a short-term recommendation, remember, just 1 to 3 months. So it's not really going to help you to tell you whether or not to sell Facebook, but it's still, the rank is a good way to get into a system type of investment. So let me recap those tickers. VCEL is VCEL. Then we did talk about Tesla many times, TSLA. Facebook is FB. CHWY is CHWY. Alibaba, BABA. Trade Desk is TTD. Zoom Video is ZM, remember, not Zoom. It's ZM. Square is SQ. BIDU, BIDU. And then we had Roku there at the end, ROKU. And as always, be sure to subscribe so you don't miss a single market edge, especially when I have Kevin back on to talk about the CRISPR stocks. You want to make sure you're subscribing to get it at all times. You can get us on Spotify and on Apple Podcasts and many other platforms, including SoundCloud. But get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.